Hello everyone, myself Dr. Vinay Gandal from KMC College Khopoli, and today I'm going to talk about capital gains. So dear student, as you know that capital gain is one of the head of income, and whatever capital gain is arising from the previous year or during the previous year is always chargeable to tax. Okay, so in this lecture we will discuss about meaning and chargeability of tax under capital gain. Also we have to study about various types of capital assets like short-term capital asset and long-term capital asset. We will also see various types of capital gains like short-term capital gain and long-term capital gain. And also we have to understand cost inflation index for the purpose of calculation of long-term capital gain. And we have to study the detailed procedure of computation of capital gain under two types of capital gain like short term and long term capital gain. And also we have to learn about deductions allowable under section 54 from the income tax point of view. Okay, so first of all we have to learn about meaning of capital gain. So the question is arise, what is actually capital gain and how it is chargeable to tax? So dear students, capital gain means any profit or gain which is arising from the transfer of capital asset. It is treated as an income of the previous year in which the transfer takes place. Okay. In general, capital receipts are not taxable, but gains or profits from the transfer of certain capital asset is treated as income which is chargeable to tax under the section 45 of Income Tax Act 1961. So it is very necessary for all of us to understand the basis of charge. Okay, so as per section 45, any profit or gain which is arising from transfer of capital asset is always chargeable to tax under the head of capital gain in the previous year in which the transfer took place. Okay, and it is also said that capital gains tax liability arises only when some basic conditions are satisfied. So for the purpose of basis of charge under capital gain, there must be a fulfillment of some basic conditions. The first condition is that there must be a capital asset. So when we talk about capital gain, there must be a transfer of capital asset, and the capital asset must have been transferred by the assessee, not by other persons. Okay, and third condition is that transfer must be take place during the previous year. Okay, means whatever transfer of capital asset is to be undertaken during the previous year, so the capital gain arising from that capital asset is chargeable to tax if there is a capital asset and the capital asset must have been transferred by the assessee. Okay, so these are the basic conditions that must be fulfilled by the assessee while computing tax liability in the case of capital gain as per section 45. Okay, now we are going to learn about capital asset. Section 2 subsection 14 provides that capital asset means any kind of movable or immovable property which is held by the assessee. Or capital asset means any property of any kind held by an assessee, whether or not connected with his business or profession. And also any types of security which is held by foreign institutional investors which has invested in such security as per the rule under SEBI Act 1992. Okay, and now we have to consider the types of capital assets. So there are two types of capital asset, like short-term capital asset and long-term capital asset. As per section 2 subsection 42A, short-term capital asset means the capital asset which is held by an assessee for not more than 36 months. Okay, immediately preceding the date of transfer. Or in the case of shares held in a company or other security, the asset or shares which is held by the assessee less than 12 months is also called as a short-term capital asset. Okay, and section 2 subsection 29A gives a definition of long-term capital asset, means the capital asset which is not short-term capital asset, and if the asset which is held by the assessee for a period more than 36 months, or in the case of shares, the shares which is held by the assessee for a period more than 12 months is called as a long-term capital asset. Okay. Now, it is necessary for all of us to understand the types of capital gains. Okay. So, dear students, there are two types of capital gains. First is short-term capital gain. So, as per section 2 subsection 42B of Income Tax Act 1961, short-term capital gain means the capital gain which is arising from the transfer of short-term capital asset. And for the tax purpose, normally short-term capital gain is classified into two categories, like short-term capital gain arising from sale or transfer of listed securities, and short-term capital gain arising from transfer of short-term capital asset other than listed securities. So these are the two sub-classification of short-term capital gain as per section 2 subsection 42B. Okay. Second type of short-term capital gain is long-term capital gain. And as per section 2 subsection 29B, long-term capital gain means the capital gain which is arising from the transfer of long-term capital asset. And generally for tax purpose, long-term capital gain is classified into two categories. First, that is long-term capital gain arising from sale of or transfer of equity shares in company or units of an equity oriented funds of listed securities, and long-term capital gain which is arising from the transfer of long-term capital asset other than listed securities. So these are the two types of sub-classification of long-term capital gain as per section 2 subsection 29B. Okay. Now we are going to learn about computation of short-term capital gain. Dear students, computation of short-term capital gain is a systematic procedure, and separate procedure is to be followed while computing short-term capital gain as well as long-term capital gain. So first of all, we have to see the simple chart for computation of short-term capital gain. In this case, first of all, we have to consider full value of consideration, that is sales proceeds from transfer of short-term capital asset, and we have to deduct from sales proceeds like full value of consideration a cost of acquisition of asset, cost of improvement to the asset, or any expenditure on transfer of asset is made on the date of transfer. So after deducting such a cost of acquisition, cost of improvement and expenditure, we can get short-term capital gain, and assessee is allowable for exemptions under section 54B, 54D, 54G and 54GA. And after deducting or after allowing exemption under section 54, we can get short-term capital gain which is chargeable to tax at a flat rate of 15%. Means short-term capital gain is always chargeable to tax at a flat rate of 15%. Okay. Then we have to consider the chart for computation of long-term capital gain. In this case, first of all, we have to consider full value of consideration, or it is called as sales proceeds from transfer of long-term capital asset, and we have to deduct indexed cost of acquisition, indexed cost of improvement and expenditure on transfer of asset, and after deducting all these index cost of acquisition, improvement and expenditure, we can get long-term capital gain, and assessee is also allowable for exemption under section 54, 54B, D, 54EC, 54F, G and 54GA. And then finally we can get long-term capital gain which is chargeable to tax at a flat rate of 20%. Means long-term capital gain is always chargeable to tax at a flat rate of 20%. Okay, so this is the separate chart for computation of short-term as well as long-term capital gain. Okay. So dear students, in the case of computation of long-term capital gain, we have to consider indexed cost of acquisition, indexed cost of improvement. Okay. So the calculation of indexed cost of acquisition is an important stage. So first of all, it is must for us to understand what is actually indexed cost of acquisition. So normally in the case of long-term capital gain, the amounts to be deducted from the full value of consideration includes indexed cost of acquisition and improvement. And indexed cost of acquisition means the amount which bears to the cost of acquisition the same proportion as cost inflation indexed for the year in which the asset is transferred bears to the cost inflation index for the first year in which the asset was held by the assessee. It means we have to consider cost inflation indexed for the purpose of calculation of indexed cost of acquisition, and cost inflation indexed is available from 1st April 2001. Earlier it was 1st April 1981. Okay. So dear students, keep it in your mind. Normally index cost of acquisition is to be calculated by using a simple formula like this. Cost of acquisition or fair market value as on 1st April 2001, whichever is more. Earlier it was 1st April 1981. So whatever cost of acquisition or fair market value if asset purchased on or before 1st April 2001, so the higher value we can consider here divided by CII, that is cost inflation indexed for the year of purchase, or 2001 2002 if asset acquired before 1st April 2001. So this is the simple formula we can use while determining indexed cost of acquisition as well as indexed cost of improvement. Okay. Then while determining indexed cost of acquisition, we must know various cost inflation index. So we have to consider cost inflation index of the year at which asset is purchased or is to be transferred. Okay. So for the purpose of income tax calculation, government gives various cost inflation index. So this is the chart which shows various cost inflation index from the financial year 2001 to up to financial year 2019-20. So during 2001 to cost inflation index was 100, and now for financial year 2019-20 cost inflation index is 289, and it was 280 for the year 2018-19. Okay, so while determining long term capital gain, we have to consider appropriate cost inflation index which is available in front of us. Okay, so these are the chart which shows various cost inflation index, and that is must to consider while determining long term capital gain. Okay, so if you are having any questions in relation to capital gain and their provisions, you can ask or comment. Thank you.